Ask an Indian family what they're really saving for, and sooner or later, the answer turns to land, a flat, a plot, or a house with the family's name finally on the registry. It doesn't matter if that family is a farmer in Bihar, a software engineer in Bangalore, or a shopkeeper in Surat. At some point, almost every one of them starts talking about buying property. This video isn't about that property. It's about that conversation about why it happens in almost every Indian household across income levels, regions, and generations in a way it simply doesn't happen in any other country in the world. Why has owning land or a home become the default definition of making it in India? Not a car, not a stock portfolio, not even a bank balance, land. The question sounds simple. It isn't. Answering it means understanding how value actually gets created on a piece of ground. It means tracing a colonial era land system that is still quietly shaping court cases today. It means explaining why Indian households keep almost all of their wealth in physical assets while much of the rest of the world actually prefers to hold them on paper. It means meeting everyone actually competing for the same square foot of Indian soil. A young couple saving for their first home, an NRI in Dubai wiring money back, and a private equity firm which is chasing a yield target, and increasingly and more commonly, a data center that will never have a family living inside that land at all. The scale of what's actually happening here is absolutely enormous and almost invisible because it plays out one family, one flat, one plot at a time. Put those individual decisions together and they add up to one of the largest wealth creation systems modern India has ever built, worth more in dollar terms than the entire economies of most countries on planet Earth, and still growing faster than almost anything else in this country. Folks, this is not a video about where to buy a flat or when. It's actually a video about decoding the machine behind that decision even before you go on to make it. This, ladies and gentlemen, is decoding India's real estate markets. Real estate, in its simplest form, is any legal claim on land and whatever is built on it: a farmhouse, a flat, an office tower, or even a warehouse. Every version of this in this particular video, right from a 2-acre plot in rural Madhya Pradesh to a data center outside Chennai, comes back to one underlying question. Why is one piece of land worth vastly more than another piece of land right next to it? Take Mumbai. If you travel about 90 minutes south of the city, you will end up in a coastal town which is actually called Alibag. And land, ladies and gentlemen, sells for somewhere around 4,000 rupees and onwards a square foot. Drive the other direction into South Bombay into a street or road like the Altamont Road, and an apartment can sell for close to 2 lakh rupees and above for a square foot, 50 times more on the same coastline under the same monsoon in the same country. The dirt isn't the difference. What's different is everything built around that dirt. Land actually has no value on its own. A plot is worth something only because of what sits near it or what could legally be built on it. Five forces go on to create that value, and once you understand them and once you see them, you can clearly explain almost every price difference in this video and fundamentally in the market. The first one is jobs. Land near work is worth more than land far away from work because people will pay to shorten a commute. The second is infrastructure: roads, metro lines, airports, water, and power. Infrastructure doesn't just make land more usable, it makes land more reachable, and reachable land is worth more than isolated land, even when the isolated land is objectively much nicer. The third is scarcity. An island city like Mumbai can't simply expand sideways. There's only so much land, so every additional residence bits up the price of what already exists in the market. The fourth is government policy, specifically what the state permits to be built. A rule allowing a 40-story tower on a plot makes that plot worth vastly more than an identical plot next door zoned for just 4 stories. And the fifth is actually trust. The confidence that if you buy this land, you'll actually be able to keep it, sell it, or pass it on to your children without spending a decade in court to prove that it's actually your land. This last force matters, and it matters more in India than in almost any comparable economy, and it's a thread that we'll keep pulling onto in this particular video. Now, when you put those 5 forces together, the land stops looking mysterious. It's the price of access. Access to income, access to connectivity, access to a scarce resource, access to legal permission, and lastly, access to certainty. Everything else in this video, every chart in every city, is those 5 forces playing out over and over in just fundamentally different combinations. To understand why Indian real estate behaves the way it does, you have to go ahead and look at who was allowed to own land and how securely, going back to almost 2 centuries back. Under the British colonial rule, land ownership in most of India wasn't really about ownership at all. It was about revenue. Systems like the Zamindari settlement in the east and the Rotwari settlement in the south and west existed mainly to let the colonial state collect land tax efficiently. Exactly who held secure, providable title to the land underneath a farmer feet was for millions of families a much murkier question, and that ambiguity didn't disappear. In 1947, it got inherited and still surfaces across courtrooms today, as in when I speak. For the first 4 decades after independence, ladies and gentlemen, land and large scale property development sat mostly inside a state controlled economy where government permission, not market, demanded and decided what could be built by whom, when, and where. Private capital had very limited room to be built at real scale. Now, that actually began changing after the 1991 policy declaration. When India opened itself to private and foreign investments, real estate slowly stopped being something only the state or a handful of large family run builders did and started attracting organized private capital looking for immense returns. The next major shift arrived from an unexpected direction: software. Through the 1990s and the 2000s, India's IT industry turned Bangalore and later Hyderabad from mid-sized state capitals into national magnets for talent and construction. Office parks needed to be built, so did the housing, right, to put thousands of new engineers within the reach of them. The IT boom didn't just go on to create income, it created entirely new real estate demand in cities that had never seen anything remotely like it. In 2005, the government introduced special economic zones, designated and dedicated areas offering tax breaks and simplified rules. This meant drawing large scale industrial and exports investments could go up significantly. They went on to reshape land use around dozens of cities through economists and a lot of policyholders still debate about how much lasting impact and how much of benefit did it actually deliver relative to the tax revenue just given up. Two more recent changes did more to shape today's market than almost anything that came before them. In 2016, the government introduced RERA, the Real Estate Regulation and Development Act, which for the very first time forced developers to register projects, deposit a share of buyer payments into an account, earn marked specifically for construction, and face real penalties for missing actual delivery dates and commitments. Then, in 2017, the goods and service tax replaced a tangle of separate state and central levies within one national tax. Real estate eventually settled into its own particular version of that one system, a small 1% rate on affordable homes still under construction, 5% on other homes still being built, and notably, nothing at all once a project is actually finished and a buyer purchases it ready made. That one rule, no tax on a completed home, quietly shapes how developers time their launches to this particular day. 200 years took India from a land system built to extract revenue to one actually attempting policy by policy to guarantee trust instead. That attempt is still very much in active and it's very much in progress, and it shows up everywhere in the rest of this video. Here is the number that actually explains more about Indian real estate than any policy or price chart. According to the Reserve Bank of India's own Household Financial Committee, the average Indian household holds close to 77% of its total wealth in real estate in just one asset class. Think about it. Add gold and other physical assets, and that goes on to account for nearly 9 tenths of what a typical Indian family owns. Stocks, bonds, and mutual funds together make up a silver, which is just around 5%. Even now, after a well publicized boom in retail trading, regulatory data suggests that fewer than 1 in 10 individual households in India actually holds any market investment at all. Compare that to a country like the United States of America, where securities make up the majority of households' wealth, and the imbalance becomes obvious. Indians aren't simply choosing real estate, they are actually avoiding almost everything else that actually comes their way. Start with what land actually is. Psychologically, to a family that doesn't fully trust paper, you can see land, you can stand on it, you can show it to a daughter's perspective or daughter's in house as proof that a family is actually stable and is serious. A number in a mutual fund statement can't do any one of that. Behavioral economists have a name for this part of the lesson, right? Which is called loss aversion, and a related discomfort with uncertain outcomes called ambiguity aversion. People weigh the pain of possible loss more heavily than the pleasure of an equivalent gain. Then there's history. Generations of Indian families have lived through bank failures, sudden policy shocks, and market crashes that actually went on to wipe on paper wealth overnight. While the family's plot or the ancestral property or the house simply kept existing, rentable or farmable, regardless of what actually happened in the market, that one thing is enough to explain why Indians want to hold on so much real estate than any other asset class for that matter. It's because trust once broken is actually hard to rebuild, and India already is a trust deficit country, and it gets passed down to generations that are going to come. A grandmother's caution about keeping your money in something real becomes a grandchild's investment philosophy, even if that the grandchild has never personally lived through a bank run. Land also, ladies and gentlemen, solves a problem paper assets don't. Inheritance. A house can be divided, however awkwardly, amongst children. It can be lived in by one generation and inherited by the next without anyone needing to understand a demat account or complicated financial prerequisitions. For a joint family, working out how to pass on what it is actually built, that legibility matters enormously, and land carries status in a way portfolio simply doesn't. Owning a flat, a plot, or an ancestral land is still, for enormous parts of India, shorthand for having arrived. Now, none of this makes Indian households irrational. Given a financial system, many of them still fully trust, many of them still fully don't trust or understand, and a cultural framework that has long rewarded holding property, choosing the asset you can see, touch, and hand down is a remarkable rational response to real world uncertainty. The 77% isn't just a mistake, it's a verdict on how trustworthy everything else has felt for an absolutely very long time, with a lot of governments actually changing and building strong policies to fix the very same issue that we are actually discussing. That verdict is only now starting to show the first signs of shifting. A younger, a more urban generation with steadier salaries, workplace retirement accounts, and a stock market that finally has a track record they've watched with their own eyes is beginning to hold a slightly larger shape of its savings in financial assets than their parents actually did. It's a small shift so far, but it's not a complete reversal as such. One thing is also worth watching, because if this shift actually continues, it will eventually change which asset an Indian family reaches for first, and that would be one of the quieter ones, more consequential economic shifts in the next 20 years. And it's going to be very interesting to observe what is going to happen. Not everyone buying Indian real estate is solving the same problem, and that's easy to forget when they all show up in the same sales data. The largest group by far is ordinary first time buyers and families upgrading their homes. People solving for shelter, security, and status largely with borrowed money, largely for a home they intend to live in. Their decisions respond to interest rates, job security, and school catchment areas, and not the headlines about the global economy. Then there are non resident Indians. The Indian diaspora abroad now numbers more than 32 million people, and the money they send home hit a record above of $135 billion in the year ending of March 2025. A meaningful share finds its way into property. Recent estimates put NRI buying at somewhere around a fifth of total Indian real estate investment and only rising. Now, for an NRI, a flat in Mumbai or Gurgaon isn't just an investment, right? It's a currency hedge, a retirement plan, and more often than common, emotionally, a claim on a home to return to. Institutional investors are putting a different species altogether entirely, right? Private equity funds, sovereign wealth funds, and global pension funds have put more than $10 billion a year into the Indian real estate in recent times, chasing yields and not sentiments. Now, they don't care about how lucky a floor number is. They care about the occupancy rate, the lease terms, and exit timelines, and they overwhelmingly favor commercial assets, finished office towers, warehouses, and increasingly data centers over unbuilt residential land or projects. Real estate investment trust or the REITs exist to let ordinary investors have access to the same kind of institutional grade commercial real estate by buying a listed unit on the stock exchange the way they'd actually go on to buy a share. India now has listed REITs together holding properties worth well over 2 trillion Indian rupees, a market that has grown roughly sixfold in 6 years, even though most Indian households have still never bought one. Family offices, the private investment arms of India's wealthiest families and specialized land aggregators, sit somewhere between the first time buyer and the pension fund. Patient capital, often willing to hold underdeveloped land for a decade or more, betting on exactly the kind of infrastructure led appreciation described in the next chapters. Developers themselves are buyers too of land which they bank years ahead of construction, betting on where the next wave of jobs and infrastructure will actually go on to land. And the government actually goes on to participate from several directions at once, as a regulator through RERA and the GST, as a buyer and builder of affordable homes through schemes aimed at low income families, and increasingly as a landowner deciding where the next airport, expressway, or industrial corridor gets built. Decisions that single handedly create or destroy value for everyone else on this particular list. Excuse me. A first time buyer, an NRI, a pension fund, and even a government committee planning can all be shopping in the same city at the same time for completely different reasons. Understanding Indian real estate means understanding that it isn't one market with one kind of buyer, it's several markets layered on top of each other that happen to share the same physical land. If land comes down to jobs, infrastructure, scarcity, policy, and trust, as part 1 actually argued, then price movements are just those same five forces changing in real time. A few matter enough to walk through it individually. Employment is the anchor. Whenever a large number of well paying jobs concentrate, housing demands follow within a few years, almost mechanically. It's why Bengaluru's IT corridors and Hyderabad's western suburbs became some of the largest appreciating micro markets over the past 2 decades. The jobs arrived first and the housing price chased them. Infrastructure acts as a multiplier on top of that. When a metro line, an expressway, or even an airport gets built, it doesn't just add convenience, it effectively expands the usable radius of a city, turning what used to be a 90-minute commute to a 35-minute one. Mumbai's new coastal line road and expanding metro network and the upcoming international airport near Noida have already begun reshaping prices along their routes for years before even complete completion, because the market prices in the future is for access and not just the present time access to that one particular piece of land. Credit is another accelerator and it works both way. Now, the Reserve Bank of India cut its key policy rate by 1.25% over the course of 2025, the sharpest easing cycle in years, before pausing through the first half of 2026. Cheaper loans actually mean more buyers can afford a bigger monthly payment for the same budget, which pulls demands forward, and part of why premium home and sales accelerated sharply through the early 2026. When rates rise instead, the opposite actually go on to happen, often with a lag of several months. Supply matters just as much as demand, and it's actually shaped by construction costs, cement, steel, and labor, all of which move with their own tax rates and global commodity prices and fluctuations. As much as how much land developers choose to release, when builders actually launch more premium apartments than the market can actually absorb, prices doesn't necessarily fall. Unsold inventory simply piles up instead, setting a developer's bank balance sheet as low as burning risk rather than an immediate price correction. Indian real estate rarely crashes the way Western markets actually do, right? For most of the time, it never crashes, but it stalls. Then there's the gap between an investor and an end user, and it can pull prices and sales in opposite directions at the same time. Delhi NCR is one of the clearest and the most recent examples. Prices in Delhi and Faridabad climbed by close to 20% to the first half of 2026, even as overall sales volume across the region fell. Because a large share of the market's activity is investor driven speculation on future infrastructure, layered on top of a shrinking pool of actual affordable stock for people who simply need somewhere to live. Watching only the price chart, you'd think NCR was actually booming. Watching only the number of homes actually getting sold, you'd think it was actually struggling. Both charts are true at the same time because they're measuring two different groups of buyers with two completely different motivations. Treat India as a single real estate market and every number about it becomes close to meaningless. Treat it as a roughly a dozen different markets that happen to share a currency, and it actually starts making more sense than you actually think. Mumbai is the extreme case. An island city that essentially cannot expand outward, only upward, and more recently across a new coastal road and expanding suburbs, the physical ceiling on supply is why it actually remains India's most expensive market by a wide margin. With city-wide average prices around 37 to 39,000 rupees per square feet, and pockets of South Mumbai and Bombay running past a lakh or even 2 lakhs or more on the most sought-after streets. Delhi NCR isn't really one market at all. It's several cities: Delhi, Gurgaon, Noida, Faridabad, Ghaziabad, and even the greater Noida, each with its own dynamics stitched together by expressways and a shared metro system. It's currently India's most infrastructure sensitive market, with prices in some corridors climbing close to 20% in a single year on the back of new expressways and an upcoming international airport, even as overall transaction volumes across the region soften. Bangalore remains India's job creation engine, and its real estate has tracked that engine closely for about 2 decades. It's also the clearest case study in the video of a risk most cities haven't actually faced yet. The number of functioning lakes in the city has fallen from over 260 in the early 1960s to below 100 today. And severe water shortage in recent years have actually started nudging buyers and developers toward properties with independent water security. A city can create all the jobs in the world, but it can't reliably supply water to those homes near the jobs. The real estate around them eventually goes on to feel the pressure. And as in 11 I speak, ladies and gentlemen, this shift and this development is actually taking place. Hyderabad tells an almost contrarian story happening at the same time in every single city. Prices in its IT corridor have kept climbing, even as the IT corridor accumulates one of the largest unsold inventory overhauls in the country. Well over 100,000 completed or nearly completed units are still waiting for buyers. Developers keep building for the buyer who wants a premium apartment near tech parks. A large pool of nearby demand for a smaller, cheaper home increasingly can't find supply. Chennai and Pune sit at the stellar end of this particular spectrum, right? Chennai, as one of the most consistent performers amongst the major cities in recent data, helped by an economy less dependent on any single industry, and Pune as an auto and IT hub whose sales have finally started recovering after a rough stretch, even as its own unsold inventory has hit all-time high in terms of rupee, driven manually by developers front loading premium launches to people who are actually willing to pay that kind of a premium. Ahmedabad remains the most recent example of affordability in major Indian cities, growing steadily rather than speculatively, with its own chief city financial district positioning it as one of the markets to actually watch out for rather than the markets that have already arrived. Beyond the 7 or 8 cities that document the headlines, tier 2 and tier 3 cities are where a lot of India's actual affordable housing demand has quietly migrated and prices have actually flown out to the metro cities. And beneath the residential story entirely is a parallel set of markets which have emerged without its own logic. Warehousing have become one of the fastest growing property types in the country as e-commerce and a wave of manufacturers diversifying their supply chains both need somewhere to store and move goods. Leasing in this category rose by double digits in the most recent year alone. Data centers are now newer, but still one of the fastest growing real estate sectors than almost anything else in commercial Indian real estate. By one of the recent measures, they attract more private capital in a single quarter of 2026 than office buildings did, a category that had led to institutional investing for over a decade. Office space itself remains anchored around REIT owned towers concentrated in Bangalore, Hyderabad, Mumbai, and Pune. And at the very top and bottom of the residential markets, the divide has become impossible to ignore. Houses priced over 1 crore rupees now account for more than half of all sales in India's major cities. While housing priced under 50 lakh rupees, what most families would actually call affordable, has collapsed from roughly half of all new launches less than a decade ago to a small single digit share today. Builders follow the profit, the affordable buyer got left behind. Same country, same currency, same tax code, 10 or more real estate markets, each running on its own combinations of job, geography, infrastructure, and risk. Every real estate market has friction. India's friction are distinctive and worth explaining calmly because sensational language tends to obscure exactly how this goes on to work. Start with title. In most of India, what you get when you buy land isn't a state guarantee that you actually own it. It's a pre assumption built on paper trail of past transactions that you probably do. This is sometimes called the presumptive title testing, and it's different from countries where the government itself certifies and ensures ownership. that different that difference is actually the part why land disputes in India can run for a very long time. Commercial disputes, by one widely cited historical World Bank estimate, to close to 4 years on average to resolve through the courts, consuming a substantial share of whatever actually was in dispute. A government program called the DIL RMP has spent close to 2 decades trying to digitize land records, map them precisely, and eventually move the country toward the kind of state guarantee conservation and title that would actually make this problem largely disappear. Progress is real and uneven, and sometimes most states are ahead of others, and vice versa. Regulatory approval is in its own friction. Getting a project brought from a plot to construction ready site can require clearances from multiple municipal, state, and environmental authorities, and the exact sequence and timeline differs meaningfully from state to state. None of this is actually unique to India. Most large economies wrestle with permitting delays in some form or the other, but it adds months or years into a developer's timeline before a single brick is already laid. Costs that eventually finds its way into the price a buyer ends up paying eventually. Then there's informal cash economy that has historically shadowed Indian property deals, transactions structured to under report value or held in someone else's name entirely. A practice by the law, which is actually called Benami, India has had a law against it since 1988, strengthened substantially in 2016, and enforcement has genuinely tightened alongside digital payments, linked identity systems, and stricter reporting rules and schedules. It hasn't disappeared, but it is a shrinking share of a market that has become steadily more traceable. There's also builder's risk. Not every developer finishes what they actually start. RERA has sharply reduced the number of buyers left holding on empty plot and a builder who's vanished, but it hasn't eliminated the problem particularly, but specific to those projects that actually launched before the law actually existed. And that's the quieter risk. Sitting inside the inventory numbers from the last chapter across India's 8 largest cities, more than half a million completed or near completed homes were sitting unsold as of mid 2026. Enough at the current sales pace to take roughly a year and a half to actually clear. That's not a clash, that's not a crash, it's closer to a traffic jam. Capital tied up to concrete, developers under pressure to discount or delay their next launch, and buyers increasingly able to negotiate in a market that not long ago offered them very little room to. None of these problems are hidden in the sense of being secret. They show up in every industry. A report this video has actually drawn this inspiration and these statistics from. What makes them easy to miss is that none of them individually looks like a crisis. Added together over enough years, they are the reason building trust in Indian real estate has been slower than building the buildings itself. Everything described so far explains that the Indian real estate and its current position in today's day and age. The next 20 years will actually be shaped by forces that are only beginning to show up in the data. The most immediate is artificial intelligence and specifically the physical infrastructure that it actually needs. Data centers, the building that store and process the world's computing, have gone from a niche category to one of the most fastest growing concerns of Indian real estate almost overnight, drawing tens of billions of dollars in committed investment and in one recent quarter, more private capital than office buildings, a category that had led institutional investing for more than a decade. These buildings don't compete with people for jobs. They compete with people for power and water, and at an industrial scale in some of the cities already stretched in both. Closely related is the reshaping of the global manufacturing. As companies diversify supply chains away from being concentrated in any one single country, a shift often shorthanded as China plus one, combined with the steady rise of Indian e-commerce, warehousing and logistics real estate, has become one of the strongest performing segments in the country. With double-digit annual growth in leasing, expected industrial corridors, not just cities, to become the next geography this video would need a sequel to cover. Work itself is changing shape too. The years since the pandemic normalized remote and hybrid work for a meaningful slice of India's white-collar workforce. And some of that flexibility looks durable, but a small chunk of that, but growing number of those professionals no longer need to live within commuting distance of office days 5 days a week, which is starting to nudge some housing demands towards smaller cities and quieter suburbs that were never realistic options before. And it's a modest force next to jobs and infrastructure, but modest forces compound too. Physical infrastructure keeps compounding its own effect as well. Every new expressway, metro line, and regional airport shortens the distance between where people live and where the jobs are, and each one quietly repeats the value story from part 1 to another location altogether. A functioning international airport turns a sleepy district into a boom town within a few years of breaking ground. Then there's the risk that this industry has spent the least time pricing it. Water. India holds close to a fifth of the world's population, but only a small fraction of its fresh water. Bangalore has already lost roughly two-thirds of the lakes it had from almost a decade ago, mostly to the very construction that built its real estate boom. Chennai came close to running dry in 2019, that the crisis earned its own name. Groundwater is being polluted from more than 1,000 blocks nationally faster than it can naturally ever refill. None of this means Indian cities are about to run out of water tomorrow. It means that the location, real estate's oldest cliche is genuinely gaining a fourth word, water. And underneath all of it, India's households themselves are changing shape. Families are getting smaller, more nuclear, more likely to need a separate home earlier in life than a generation ago did. That alone creates structural housing demand that has little to do with population growth, and won't slow down just because of a market cools. None of these forces guarantee an outcome. They're simply the variations and the variables from the next 20 years this story will be written with. Some of them, like the infrastructure and shrinking household size, pushing demand up, others, like the water crisis and an aging office stock, are just fundamental risks that this industry not only has started to wake up but to actually go on to take seriously. Government bonds in some years have outperformed, not because Indians are unusually drawn to bricks and mortar by nature. Give any family in a country a financial system it doesn't fully trust, a cultural framework that rewards holding property, and an asset it can see, touch, and hold down intact, and you'll likely get the same result. Real estate became India's default store of wealth because for the last 20 years, for the last 70 years, it was the most trustworthy, divisible, and status confirming asset actually available to most families out there. Everything else, a scalable stock market, a fully digitized land registry, a pension system that most people participate in, is still being built. One policy, one generation at a time. Real estate didn't win because it's the best possible asset. It actually won because for a very long time, it was the safest bet against everything else that was actually very uncertain. Will that continue under one condition more than the other? Whether the things propping this systems to, like job creation, infrastructure, credibility availability, credit availability, keep growing faster than the things that quietly are working against it, like water stress and an oversupply of premium housing chasing a shrinking pool of premium buyers, and a title system still has a part way digitized. This video won't have you any prediction, right? Because anyone offering you that kind of confidence is actually selling you more certainty than the system actually has. And what it can hand you is a framework. Three questions worth asking about a piece of land in any Indian real estate, in any city, in any price. What is this price actually a claim on? Real jobs and infrastructure, or a speculation about jobs and infrastructure that may or may not arrive? Who else is competing for the same resource? Another family, or increasingly a warehouse or a data center or a fund manager who's trying to probe somebody else's pension? And what happens to this asset if one of its trust assumptions or the truth assumptions actually break, if the title turns out to be contested, if the water runs short, if the buyer next door was always going to be a speculator and not a neighbor? Go back to the family from the beginning of this video, the one saving for a land or a flat or a house with their name on the registry. They were never really chasing on a return on investment, right? Let's get that straight up. They were actually chasing the one thing that has felt safe to hold on to in a country still building the trust that would let them safely hold on to anything else. That, ladies and gentlemen, is the Indian real estate market. Not a mystery, a system still being decoded, one policy, one city, and one family's decision at a time.